Hey, welcome to my channel, Watu. I am your host of this channel, Watu. And on this channel, if you have not seen any videos from me prior, we focus on health, wealth, and freedom. And freedom could be a number of things for you, but for me, I know what it is, and we'll just leave it at that. So in my last video, we talked about how to use Robinhood and navigate through Robinhood. And so I figured maybe I should have talked about some of the basics and understandings of the stock market or stock exchange and some of the terms that are used, and you should probably know what they are. So in this video, we're going to talk about what are stock index funds and ETFs, what is the difference, and why you should probably focus on some more than others. So what is a stock? So a stock is a unit or share of ownership in a company. Depending on the number of shares issued by a company, that will determine your percentage of ownership in that company. So if a company offers 1 million shares of stock and you only own one share, that means you own 1/1,000,000th of that company. So commonly when you look at the news or financial news, you will see a ticker symbol for a company. This is usually 3 to 5 letters, and they typically mimic the name phonetically of the company. In the case of Facebook, Facebook's stock is FB. Ford is just F. Now, certain ticker symbols actually have a specific letter at the end that means something. And those are typically stocks with 5 letters or 4 letters, and those letters that mean something are at the very end. Companies that have a stock ending in F or Y typically means that that company is a foreign corporation. The difference between the F and the Y means this. F is solely a foreign corporation that is being traded on the US exchange markets, and companies that have Y at the end are foreign companies that have US depositories. For example, BMW is traded on the US stock exchange, but it has Y at the end of its call letters. Y meaning that that company has an American depository, although the company is a German company. Stocks that end in Q typically means that that company has had a bankruptcy in a prior time and has since recovered. Now that we know what a ticker symbol is, we can talk about basis. So when you go to buy a stock, basis is the financial term for the cost of that stock. Meaning, if I buy a stock at $5 a share, my basis in that stock is $5. If I go through a brokerage company that has fees, when I go to purchase that stock, on top of the $5, if the brokerage fee is 50 cents, that means the basis in that stock per stock, well, in that one stock, is $5.50. Now, depending upon whether or not the price goes up or down during the time of ownership of that same stock I purchased for $5, if the price of the stock is now $6, my unrealized gain is a gain of $1. If it goes down to $4, my unrealized loss is a loss of $1. Unrealized and realized is the difference between me still holding the stock or me having sold the stock. Now, if I sell the stock, that is when an unrealized gain becomes a realized gain. And then it becomes a tax event which I need to report on my individual taxes. Brokerage firms will typically give you at the end of the year, usually a few months after the year has ended, a statement with all your stock sales. Those sales will be a record of your realized gain and losses, which will affect your adjusted gross income on your taxes. We can get into taxes at another time. Why do companies issue stocks? So companies typically issue stocks for a multitude of reasons. Usually a company will issue stock in their early stages when they want to go public because they're trying to grow the company. They need that funding from investors in order to help the company grow, whether it's doing more research and development, creating a project, bringing a project to market, or they needed to cover the growth of the company as far as staff working for that company. Companies will do this not only for just the prestige of being a traded company on the stock exchange, but they will also do it to avoid loans and avoid debt on their balance sheet. A company with less debt or less liabilities and more assets is a better off company in most cases. Money brought into the company through investors will be considered an asset because the money is not owed back to the investors. When the money is taken from the investors, those investors receive ownership in the company. In order for a company to go public on the stock market, a company must have a formal valuation done by a third party in order to determine what the actual value of that company is. Once that value is determined by a company, that will determine the price per share when shares are offered on the market. This offering is called an initial public offering. In order for a company to go public on the market outside of doing the valuation, a company must submit financials as well as other registration forms to an organization called the Securities and Exchange Commission, also popularly known as the SEC. Once a company has been granted the ability to go public and the SEC has approved them, they must continue to file Forms 10K and Forms 10Q. These consist of that company's financials as well as any improvements or notable events that have happened with that company. And this is almost like a report card for the company. These reports help to minimize stock manipulation and to instill trust in investors to forfeit their money to get ownership in a company. The last thing you want to do is invest your hard-earned cash into a company that isn't reputable or can have trusted financials. That's the whole purpose of the SEC, as a protection for investors. The funny thing about the IPO is, let's say a company like Facebook, who first did an initial public offering of less than $30. When that initial public offering happened, it wasn't a stock that hit the market at that price. When companies do initial public offerings, they actually are offering that price to institutional investors and anyone who has close connections with the company that they see fit offering that initial price to. The purpose of owning stock is simple: to make more money. How do stocks make us more money? Well, we've already talked about the idea of unrealized and realized gains. The second way is passive income. Now, depending upon the company, that company may or may not pay dividends. Depending on how high that dividend yield number is, will determine how large of a dividend you will receive. Now, companies that are newer are growth companies like your Snapchats, your Twitters, your Teslas. They're not going to likely pay out dividends early on because they are still in a growth state. They are still using your money to help grow and invest in their company for growth. But companies that have been around for a while and are out of that growth stage will have a dividend that they pay out. Companies like Johnson & Johnson, Ford is famously known for them paying out dividends, even to their own detriment, in my opinion. These companies will pay dividends. So not only are you buying the stock with the intent of it growing to a higher price when you go to sell it in the future, but you're also making money off of that stock on a quarterly basis, depending on whether or not that company pays out dividends. And if they do pay out dividends, it's going to be based on how much profit they brought in per quarter or annually. Stocks go up and down for many different reasons. These factors can be within the control of the company or outside of the control of the company. An example of something that would affect the stock to go down would be, of course, today's news that everybody is talking about is the pandemic. The pandemic has affected many businesses in many ways where they can't get the customer base. Many of their customers have lost funding and they just can't buy products. So this will cause in the future, probably within the next quarter, for many stocks to go down as their financials will reflect poorly on how business is going. So a stock can go up for many reasons. A stock typically will go up on a quarterly basis if that company is meeting or exceeding the guidance that is put out on a quarterly basis. This is an estimate of how that company thinks it will be doing as far as net income goes, and also what debt they carry and what achievements they've made within that year, or quarter, I should say. That's just one reason. Stocks can also go up because of outside factors. In one case, just a week ago, the stock market decided to go up because of a trial that went well as far as the pandemic goes. The trial went well, so because of that, the thought process for many investors was, okay, well, now that there's something that can potentially help people during this pandemic, maybe this will help the economy recover quicker and people won't need to be in the house as much, and they can go out and spend money and keep the economy going. So an index fund is a type of mutual fund with a portfolio contracted to match or track financially a sector in the market. An example of this is the S&P 500. The Standard & Poor's 500 represents the top 500 companies within the U.S. economy or the U.S. stock exchange. These companies are from all different sectors, and they give a good picture as to how the overall economy is doing for the year. The benefit to owning an index fund is, rather than owning a stock where you're paying money for this stock to have ownership in one company with the hopes of this company doing well and so many different factors going into that price going up and down, having money within an index fund allows you to take that same money that was used to buy one stock, and now you have what is considered to be ownership in many stocks. An index fund can be purchased through what is a mutual fund company. These are typically through large institutional companies that do investing, through your 401k or any other retirement portfolio plans. Most of that money is invested in index funds. This helps keep your portfolio diversified and safe from one of those companies potentially failing and you losing all your money in one company. It kind of averages out your risk and lowers the risk of your investment, because typically with investments like the S&P 500, they on average do about 7% growth a year versus what a bank account or savings account, which is clearly at almost 0% now. An ETF is an exchange traded fund. It's a type of security which involves the collection of multiple securities. Many ETFs mimic what index funds are. So while you can get only an index fund through a mutual fund, you can get an ETF which mimics that index fund directly from the stock market. So if I decided to go to the stock market, rather than being a member with Vanguard's investment firm, I can also go onto the market directly through my Robinhood app and buy one of Vanguard's ETFs, which also tracks the same indexes. So now that I have explained what stocks, ETF, and index funds are, maybe now you may feel comfortable enough to go out and invest on your own, but you don't have a brokerage account set up. Well, if you haven't set up a brokerage account, I would strongly suggest two that I am an affiliate with. Yes, I will see some benefit, but it will also benefit you. Two brokerage companies that I use are Robinhood and Webull. Both of these companies allow you to invest directly from your phone. They do have SIPC insurance, and with the both of them, they offer free stock when you sign up. Now, Robinhood will give you a free stock if you just sign up with them. They don't have a minimum funding requirement. With Webull, they do require you to fund the account with at least $100, and they will give you two free stocks. The first stock is up to a value of, I don't know, $250, $240, and the second stock is up to a value of $1,400. It's a lottery. You don't get to pick the stock. No, you're not going to get an Amazon share off the rip, okay? They will choose the stock for you. So I will put the links below for those, and you can check those out. And until the next time, guys, thank you so much. If you have made it to the end of this video, this is now, I can't tell you the number of times I have recorded this, and hopefully this is it, guys. So I will see you in the next video. Until then, have a great day, great morning. Go be great.